Dutch Tulip Mania. It all began as a symbol of wealth and beauty. In 17th century Holland, rare tulip bulbs were the ultimate status investment. Prices soared as traders bought contracts, not flowers, betting that someone else would pay more tomorrow. The market grew on easy credit and sheer optimism, with some bulbs selling for more than a house in Amsterdam. Then, in February 1637, buyers vanished overnight. Auctions failed, confidence evaporated, and prices collapsed by more than 90% in weeks. Fortunes disappeared as quickly as they'd formed, the Dutch economy survived, and Tulip Mania became known as the first speculative bubble in history, a wild moment that barely affected the wealth of the Dutch Republic, one of the richest nations in the world. But soon, the world would trade flowers for steel, laying track straight into its next bubble. UK Railway Mania. Sometime in the 1840s, railways were the internet of their day, a new technology promising to connect everything and make investors very rich. Cheap loans and weak oversight from Parliament triggered a rush to invest in new railway companies. Over 1,000 companies planned new lines, many without routes, revenue, or rails. Borrowed capital and public enthusiasm drove prices sky high. Investors ignored the risks, caught up in the excitement of a booming new industry. Then, interest rates rose, construction stalled, and investors realized most projects would never pay back. Eventually, shares collapsed, wiping out middle-class savings but leaving behind Britain's rail backbone. But while trains transformed Europe, the next mania took root in a different kind of empire, one made of trees and tires. Rubber share boom and Shanghai crisis. As cars took over the world, rubber became the next miracle material. Investors in London and Shanghai poured money into new plantations, expecting endless profits from tires. Prices and company shares soared tenfold, fueled by leverage and wild speculation. But the boom was built on fraud, false yields, and borrowed funds. When rubber prices slipped in 1910, panic hit both markets. Over 50 Shanghai banks collapsed as loans went bad, wiping out local fortunes. London investors lost millions. The bust exposed how global demand, hype, and credit could intertwine into disaster, a template repeated in countless commodity bubbles to come. Roaring Twenties U.S. stock bubble. After World War I, America's economy was booming. Factories, cars, and radios promised endless growth, and the stock market became the quickest path to wealth. Borrowing to invest was easy. Brokers offered loans covering up to 90% of a trade's value. The U.S. stock market jumped 6 times higher in just 8 years. It seemed like prices could only rise and rise. When people finally realized the boom couldn't last, panic hit the market in October 1929. In just 2 months, the market lost nearly 50% of its value, and $30 billion evaporated. Then the Great Depression followed, reshaping global finance for generations. Decades later, the Roaring Twenties spirit returned, this time wired into a world of circuits and transistors. U.S. Tronics boom. By the late 1950s, electronics were the next big thing. Transistors, computers, and satellites captured the public's imagination. Anything ending in Tronics or Onyx became a magnet for cash. Hundreds of small tech companies went public, many with little more than ideas on paper. Their share prices skyrocketed on Cold War optimism, but profits never came. As in other events, belief replaced analysis until the math broke. When investors realized the numbers didn't add up, the bubble burst. The market crashed 27% in 1962, and many Tronics stocks lost up to 90% of their value. As electronics fizzled out, investors dug deeper, literally, chasing riches buried under the soil. Poseidon nickel bubble. In 1969, an Australian mining company called Poseidon NL announced a major nickel discovery at Windara, a remote site in Western Australia's goldfields region. Nickel prices were soaring worldwide, and investors went wild. The company's shares shot from 80 cents to 280 Australian dollars in just 6 months, a 350-fold surge. Dozens of other mining firms followed, promising riches in the ground. But as tests proved disappointing and global prices cooled, the illusion shattered. By 1970, Poseidon's shares plunged back to 10 Australian dollars. Fortunes disappeared, and public trust in the stock market collapsed. Regulators would tighten disclosure laws, but the legend of Poseidon remained Australia's most spectacular boom and bust story. But the real gold rush was still ahead, and this time, it was actually about gold. Precious metals bubble. By the late 1970s, fear ruled the markets. Inflation was surging, oil prices were spiking, and investors fled to gold and silver as safe havens. Two wealthy Texas oil heirs, the Hunt brothers, tried to corner the world's silver market by buying huge amounts of physical silver and futures contracts. Prices exploded from $6 to nearly $50 an ounce in 2 years. But when regulators made investors put up more cash for their trades, the whole system collapsed. On Silver Thursday, March 27, 1980, silver crashed over 50% in a day. The Hunts went bankrupt and thousands of investors were wiped out. Another dramatic lesson in the dangers of leverage and speculation. Fast forward 20 years, and fear gave way to euphoria as the world logged on to the internet's first big illusion. Dot-com bubble. The internet promised to change everything, and investors believed it. From 1995 to 2000, the NASDAQ climbed nearly 600%, powered by startups with no profits and often no products. Venture capital poured in, and IPOs, processes in which a company sells shares to the public for the first time to raise money, happened so quickly, creating paper billionaires almost overnight. But most companies had no viable business. When earnings disappointed, confidence collapsed. By 2002, the NASDAQ had lost 78% of its value, erasing $5 trillion. Many startups like Pets.com and Webvan disappeared, but the infrastructure they built survived, laying the groundwork for the next wave of innovation, the social web. As the dot-com fireworks dimmed, ultra-low rates and Wall Street's alchemy steered the mania from websites to mortgages, laying the foundations for the onset of the next bubble. U.S. housing bubble. After the dot-com crash, cheap credit and faith in homeownership fueled a massive housing boom. Banks pushed subprime loans, risky mortgages given to people who normally couldn't afford them. They bundled these loans into safe securities and sold them to investors. Home prices doubled in a decade. Speculation and easy money replaced real profits, driving the market higher. And when homeowners stopped paying their loans, the whole system started to fall apart. Mortgage-backed securities collapsed, triggering bank runs and a global panic. Lehman Brothers, one of the largest banks in the US and heavily invested in the housing market, went bankrupt, sending shockwaves through the financial system. Trillions evaporated. The Great Recession began, proving again that leverage and optimism make a deadly pair. But while homes were falling, oil was exploding, a bubble that burned hotter than anyone expected. Commodity and oil spike. As the world economy overheated, oil became the hottest trade. Hedge funds and speculators piled in, convinced prices would rise forever. By July 2008, crude hit $147 a barrel, a record high. As oil prices climbed, airlines and truckers just couldn't keep up with the costs. The surge was fueled by borrowed money and blind confidence. And when demand collapsed, oil plunged 78% to $32 within 6 months. It was another lesson that even physical assets can inflate into fantasy when money is too cheap and conviction too strong. As oil prices collapsed, the world looked elsewhere for the next big boom and found it in China's soaring stock market. Chinese stock market bubble. Fueled by optimism and margin debt, China's stock market became a national obsession. Millions of first-time traders borrowed to buy shares, and the Shanghai Composite, China's main index tracking industry, doubled in less than a year. Families mortgaged homes, convinced markets would never fall, just as Americans had believed a decade earlier. When growth slowed and regulators tightened lending, the bubble burst. Within weeks, stocks crashed 30%, erasing $3 trillion. The government halted trading and banned sales, but even state control couldn't stop the panic. As Shanghai's screens went red, the next bubble, a borderless, code-based speculation, lit up worldwide. Bitcoin bubble. Bitcoin's first explosion turned crypto from curiosity to mania. Starting the year below $1,000, it rocketed to nearly $20,000 by December, a 20-fold surge that stunned the financial world. Everyone piled in: techies, students, retirees, even hedge funds, all caught up in the same fevered excitement. But this rise was built on belief, not actual use. Exchanges crashed, scams flourished, and governments began to step in. When regulators cracked down and enthusiasm cooled, Bitcoin plunged more than 80% within a year. Fortunes vanished overnight, yet the idea endured, setting the stage for the next, even bigger, digital frenzy. Crypto supercycle. Locked at home due to COVID and flush with stimulus cash, investors rushed back into crypto. Bitcoin climbed from $10,000 to an all-time high of $69,000, while Ethereum, meme coins, and DeFi projects exploded. New tokens launched daily, each promising life-changing returns. It felt unstoppable, driven purely by hype and the belief that prices would only go up. But leverage, fraud, and hype eventually unraveled the dream. Major exchanges imploded, hedge funds went bankrupt, and prices collapsed by more than 70%, wiping out hundreds of billions in paper wealth. The so-called supercycle ended the way all bubbles do, proving that euphoria always has a short memory. And just when it seemed speculation couldn't get stranger, Reddit proved otherwise. Meme stock mania. It started as a joke and became a revolt. On Reddit's Wall Street Bets forum, regular investors worked together to bet against hedge funds that were betting GameStop and AMC stock would go down. By buying in a coordinated effort, buyers pushed GameStop stock up over 1,700% in just 3 weeks, making ordinary traders millionaires, at least on paper. For a brief moment, retail investors moved Wall Street itself, but when brokers halted trading and the hype faded, prices crashed more than 80%. Most latecomers lost everything, yet the message was unforgettable. Markets now move at meme speed. And if stocks could turn into memes, art could too, and it did, one JPEG at a time. NFT boom. Digital art became the new gold rush. NFTs, or non-fungible tokens, were digital ownership certificates, proof you own something that only existed online. They sold for millions, with people's everydays fetching $69 million at Christie's. Everyone wanted in, from athletes to influencers to entire brands minting digital collectibles. People paid millions not because of use, but because they believed it was valuable. For a few wild months, pixelated apes and cartoon cats were treated like fine art. But when the hype cooled, trading volumes fell 90% and prices collapsed almost overnight. What remained was proof that ownership itself can be speculative when it exists only on a screen. Evergrande and China's property crisis. For 2 decades, China's real estate boom powered its miracle economy. Developers like Evergrande borrowed endlessly, building vast projects financed by pre-sales and debt. Apartments stopped being homes and became chips in a high-stakes game. By 2021, Evergrande owed $300 billion and ran out of cash. Construction froze, buyers protested, and confidence collapsed. Prices fell, wiping out trillions in paper wealth. Even China's command economy couldn't contain the fallout. Even as China's towers shook, the West was busy bidding on cardboard and sneakers. Collectibles Mania. As the lockdowns hit, nostalgia met free money. Pokemon cards, sneakers, luxury watches, and even McDonald's toys exploded in value as millions of people turned to online trading. Auctions broke records, a rare Charizard card sold for over $400,000, and vintage Jordans fetched 5 figures overnight. It was crypto logic applied to childhood memories. Buy, hold, and hope for a bigger fool. For a while, collectibles looked like the safest bet in an uncertain world, but as stimulus faded and reality returned, prices collapsed by as much as 80%. The fun bubble burst, proving emotion can inflate anything, even toys. And now, the newest promise, and risk, is written not in ink or code, but in algorithms. AI and tech valuation bubble. Artificial intelligence became the next miracle narrative. Startups with little more than demos and ambition raised billions, while chip makers like NVIDIA tripled in value within a year. Every company suddenly called itself AI-powered, just as every startup once called itself .com. Investors poured in, terrified to miss the next technological revolution. But expectations quickly outran reality. Rising interest rates and slower adoption cooled the frenzy, and valuations began to slide. Echoing the dot-com era 2 decades earlier, the excitement proved that markets may evolve, but psychology doesn't. Whether this ends in a soft landing or a crash, human behavior never changes.